Welcome back to the deep dive. Today, we are stripping away all the gloss, all the excitement of making a really big purchase, and we're looking at what is probably the single most painful moment in that entire process. You know exactly the moment I'm talking about. You've done all the shopping, you've mentally moved your furniture into the new house, or maybe you've pictured yourself driving down the coast in that brand new car.
The emotional buy-in is there. It's 100%.
It's totally there.
Yeah.
You are ready. And then you sit down at a desk, usually across from someone in, I don't know, a suit or a very stiff blazer, and things get incredibly real.
The moment of truth.
The moment of check writing. We are talking about the down payment, and I think for most of us, this is just, a hurdle. It's a nuisance. It's that massive number you have to hit before you're allowed to join the club of ownership.
Right.
But looking at the research we've pulled together for this deep dive, it turns out this isn't just about handing over a pile of cash. It is arguably the most important economic filter in our society.
It really is. It's the gatekeeper. And it's a fascinating mechanism because it sits right at the intersection of psychology, risk management, and frankly, banking history. It's the thing that separates window shopping from a binding legal transaction.
Right. And typically we just accept it. We complain about it, sure. Have to save 50 grand or whatever the number is for you. But we rarely stop to ask the fundamental question, why?
Oh, yeah.
Why does the system demand this specific chunk of cash up front? Why can't I just borrow the whole amount if I have a good job and a high credit score? Why is the bank so obsessed with this initial friction?
It's a great question because on the surface, it seems completely counterintuitive for a bank to turn down lending more money. You'd think they'd want to lend you every single cent possible to maximize the interest they make.
Yeah, that's what I thought.
But the down payment exists because the financial system is actually quite fragile, and this pile of cash is the glue holding a lot of it together.
So our mission today is to unpack that fragility. We're going to look at what a down payment actually is, beyond just a wire transfer, and look at it from the lender's side, the borrower's side, and then we're going to take a pretty wild tour through the history of how these numbers have shifted, especially during the, let's call it, chaos of the mid-2000s.
And I think you're going to be surprised to find that the down payment is actually a communication tool.
A communication tool.
Yeah. It's a signal you're sending to the market,
Yeah.
and it's a shield the market is using against you.
A shield against me. That sounds a little ominous. I like it. But before we get into all the heavy economic theory, let's ground this in the basics. We need to define our terms so we're all on the same page. When we say down payment, strictly speaking, based on the source material, what are we describing?
Okay, so at its most basic level, a down payment is an initial, upfront partial payment for the purchase of expensive goods or services.
And every word in that definition matters, right?
Every single one. Initial means it happens before the transfer of ownership is truly complete. Partial means it's not the whole price. It can't be.
And expensive goods. I mean, we aren't talking about putting a down payment on a cup of coffee.
Exactly. The source material highlights the two big ones that really drive the U.S. economy. Cars and real estate. Houses. These are high-ticket items where the cost significantly exceeds what an average person has in discretionary income each month.
So not something you just buy on a whim.
Not usually.
Yeah.
I mean, you don't typically make a down payment on a new pair of shoes, although with all the buy now, pay later schemes out there, that line is getting a little blurry.
That's a whole other deep dive.
It is. But traditionally, this is for assets that require long-term financing.
And mechanically, this has to be liquid, right? I can't pay my down payment in, promises or stock options.
No, it is almost always paid in cash or a cash equivalent, cashier's check, a wire transfer, right at the moment the transaction is finalized. It is liquid capital leaving your possession instantly.
And the definition implies that there is a remainder.
Right. The down payment is only one part of the equation. The rest of the cost, the remainder, is covered by a loan of some sort. So the down payment is effectively the wedge that opens the door for all the financing. You pay the first chunk, the bank pays the rest, and then you pay the bank back over a long, long time.
I did notice one little linguistic nugget in our notes. If we have any listeners tuning in from, say, London or Manchester, they might be thinking, we don't call it that.
That's absolutely true. In British English, this concept is almost exclusively referred to as a deposit. You put down a deposit on a flat.
But it's the same thing, functionally.
Functionally, whether you call it a deposit or a down payment, The economic mechanics are identical.
Right.
It's that first chunk of cash. It's your skin in the game.
Skin in the game. I like that phrase. Okay, so we've established the what. It's that painful check. Now I really want to get into the why. And I want to start with the entity that is demanding this money. The lender. The bank. Because I've always found this dynamic so strange. If a bank's business model is basically renting money, which is what a loan is, why do they force me to pay a huge chunk of the purchase price myself? If I buy a $500,000 house and I put $100,000 down, the bank only gets to lend me $400,000. They are missing out on earning interest on that initial $100,000.
Yes.
So why would a greedy bank voluntarily lend less money?
That is the logical trap that I think almost everyone falls into. You're assuming the bank is purely focused on profit maximization on a single, isolated deal. But banks are actually in the business of risk management and, just as importantly, capital efficiency.
Okay, break that down.
The down payment serves two critical functions for them. And the first one ties into the very machinery of how modern banking works: capital.
Capital. Okay, walk me through this, because this touches on fractional reserve banking, right?
Right.
Which is a phrase that, I gotta be honest, usually makes people's eyes glaze over.
It does, but it's actually kind of thrilling if you realize what it implies.
Mm.
The source material notes that the down payment ensures the institution has enough capital to, and I'm quoting here, create money for a loan.
Create money. That sounds like magic. Or, counterfeiting.
It's a little bit of both, legally speaking, of course. In a fractional reserve system, a bank doesn't just have a big vault full of cash that they lend out dollar for dollar. They're legally allowed to lend out a multiple of the actual liquid capital they have on hand. But, and this is the key, they do need some liquid capital to anchor that lending.
Okay, let me see if I can use an analogy here. It's like a lever, right? To lift a heavy object, you need a fulcrum to rest the lever on. Is my down payment the fulcrum?
That's a great way to visualize it. Your down payment is the seed capital. When you bring that $50,000 or $100,000 to the table, that is hard, liquid cash entering the bank's ecosystem. That injection of real capital strengthens their balance sheet enough to allow them to legally create the credit for the rest of your mortgage.
So in a weird way, I am financing my own loan?
You are facilitating the creation of the product you are about to buy. Without that initial injection of capital from you, the borrower, the bank would be much more constrained in how much credit they could extend across the board.
Ah.
I mean, think about it. If they lent 100% of the value to every single customer without taking any cash in, their reserves would run dry very, very quickly, and the regulators would come and shut them down. They need your cash to make the math work for the people watching over them.
That reframes the entire interaction. I always felt like I was, on my knees begging the bank for money, but really I'm bringing them the fuel they need to run their engine.
You're partners in the transaction, whether they treat you like one or not.
Yeah.
But let's move on to the second reason, which is probably more visceral for the bank on a day-to-day basis: protection.
Right. This is the safety net concept.
Exactly. When you take out a mortgage on a house, the house itself is the collateral. It secures the loan.
Yeah.
If you stop paying your monthly bill, the lender can legally take the house. We all know that part.
The foreclosure scenario, never fun.
It's never fun. But here's the problem from the bank's perspective. Lenders are terrified of volatility. They are terrified that the asset, the house, might drop in value.
Which happens. We've all seen it happen.
It happens all the time. Now, imagine a scenario where there is no down payment, zero. You buy a house for $500,000. The bank lends you the full $500,000. A week later, the housing market in your area softens by just 2%.
Okay, so the house is now worth $490,000.
Correct. And let's say, just for the sake of argument, you lose your job and default that same week. It's a worst-case scenario. The bank takes the house and sells it for its new market value, $490,000. But they lent you $500,000.
They're instantly out 10 grand.
Instantly. They are underwater on the deal from day one of the default.
So the down payment is a buffer zone, a cushion.
It is a protective moat. The source material explicitly states that the down payment reduces the lender's risk to less than the value of the collateral. Let's use that same example. If you put 20% down, so it's $100,000 on that $500,000 house, the bank has only lent you $400,000 of their own money. For the bank to lose a single dollar of their capital, the house would have to lose more than $100,000 in value. The market would have to crash by a massive amount before the bank even begins to feel the pain.
So the first $100,000 of any potential loss is my loss, not theirs.
Precisely. You are absorbing the first wave of market volatility. You, the borrower, are the shock absorber for the bank's investment.
But the sources we have go deeper than just the loan balance. It's not just about paying back the principal, is it? Because if I default, the bank has a whole lot of other costs they have to deal with.
Oh, the list of costs is extensive and, frankly, a bit depressing. If a default happens, the lender uses the proceeds from selling that house to cover a specific hierarchy of debts.
And what's at the top of the list?
First, obviously, is the remaining balance on the loan. That's priority number one. But then, right after that, come all the fees.
And I'm guessing lawyers aren't cheap.
Lawyers are not cheap. Neither are the real estate agents they have to hire to sell the foreclosed property. Then there are administrative fees, court costs. All of these frictional costs can eat up tens of thousands of dollars really fast.
And without my down payment buffer.
Without that buffer, the bank would have to pay for all of that out of their own pocket.
Yeah.
With your down payment sitting there as equity, those costs are essentially paid out of your forfeited money.
And there was one term in the research that really stood out to me. It felt like adding insult to injury. Lost profits.
Ah, yes. It's the financial concept of opportunity cost.
Explain that in the context of a foreclosure. I mean, they're already taking my house. What profits have they lost?
Okay, so let's say you stop paying your mortgage in January. It might take the bank a full year, maybe longer, to actually go through the legal process, foreclose, and finally sell the house.
Right. It's not an instant process.
Not at all. During that entire year, the bank has, say, $400,000 of its capital tied up in your property. That money is dead. It's just sitting there earning zero interest from you. I see.
Yeah.
If they had that $400,000 back, they could lend it to someone else who's paying their bills. Or they could buy a treasury bond or invest it somewhere else. They're missing out on the profit they could have made with that money elsewhere. That gap, the lost profits between your last payment and the eventual sale, is a very real financial loss for them.
So down payment is also there to cover the money they thought they were going to make off me.
Yes. It cushions that financial gap. It ensures that even if the loan goes bad, the bank's profit margin is protected for as long as humanly possible.
Man, that is a well-oiled machine. It's really designed so the house always wins.
That is the fundamental nature of lending. It is a business of risk transfer. The down payment is the primary mechanism for transferring the initial, most probable risk from the institutions to the individual.
Which brings us perfectly to the individual, the borrower. Let's flip the perspective, because if the down payment is a shield for the bank, what is it for me, aside from a very painful check to write?
For you, it's a signal, and this is where we really get into behavioral economics.
A signal of what? That I'm rich.
Not just that you have money, but that you have discipline. The source calls it a test. By requiring a down payment, the bank is forcing you to prove that you can successfully raise capital for a long-term investment.
It's the marshmallow test, basically. Can I delay gratification long enough to stack up this significant pile of cash?
Exactly. It proves you have sound finances. If you have $50,000 sitting in a savings account, it signals that you likely aren't living paycheck to paycheck. It signals that you're capable of living within your means. It acts as a filter to weed out people who might be impulsive or financially unstable.
So even if I have the income on paper to make the monthly payments, the fact that I couldn't save the down payment signals to the bank that I might be a flake.
In the bank's eyes, yes. Income is distinct from wealth accumulation. You can make $1 million a year and you can spend $1 million and $1 a year. That person is actually a very high default risk.
Right.
The down payment proves you can keep money, not just earn it.
Right. And then there is the dark side of this signal. The source mentions the ultimate consequence.
Forfeiture.
This is the part that keeps people up at night.
And it should. The rule is brutally simple. If the loan cannot be paid off in its entirety, the down payment amount is forfeited. It's gone.
Let's play this out with a character. Let's say Sarah buys a home. She puts $50,000 down, her life savings. She lives there for 2 years, pays her mortgage, but then she loses her job. The market has dipped slightly. The bank takes the house. Does Sarah get a check back for her 50 grand?
In almost all distress scenarios, no. That money is just vaporized. It's consumed first by the drop in the home's value, then by the agent fees, then the legal fees, and then those lost profits we just talked about.
Yeah.
Sarah walks away with nothing.
So that $50,000 is effectively hostage money.
That's a very dramatic way to put it. But yes,
Yes.
it creates that skin in the game we mentioned earlier. This is a crucial psychological concept.
How so?
If Sarah had put $0 down, it would be very easy, maybe even a rational economic decision, for her to just mail the keys to the bank and walk away when things got tough. Why should I struggle to pay for this house if I have no actual money in it?
But because she has 50,000 of her own dollars trapped in the drywall of that house.
She is going to fight tooth and nail to keep it. She will pick up a second job. She will cut every possible expense. She will do everything in her power to avoid default because she desperately wants to protect her initial equity.
So the down payment aligns her incentives with the bank's incentives.
Perfectly. It makes her an active participant in managing the risk of the loan.
It effectively traps you in the investment.
Or, to be more charitable, it commits you to it. Depends on your worldview.
Fair enough. Okay, so we understand the mechanism, the psychology. Now I want to look at the reality on the ground. Because we always hear this rule of thumb, it's like a mantra, you need 20% down. If you don't have 20%, don't even think about buying a house.
Right.
But looking at the U.S. market analysis in our sources, that doesn't seem to be the law of the land at all.
It's definitely not the law. It's more of a traditional guideline that has eroded significantly over time. The source establishes that the typical range for a home purchase in the U.S. today is anywhere from 3.5% all the way up to 20%.
That is a massive spread. I mean, on a $400,000 home, the difference between 3.5% and 20% is, what, $14,000 versus $80,000? That's $66,000. That is a life-changing amount of cash for most people.
It is. It's the difference between buying a house this year or maybe in a decade. And the reason for that huge spread is largely due to government intervention in the market.
Okay, so let's talk about the low end of that spectrum, 3.5%. Where does that number come from?
That is a signature number of the Federal Housing Administration, the FHA. And to understand this, we have to look back at history. The FHA was created way back in 1934.
The absolute depths of the Great Depression.
The absolute bottom. The housing market was completely dead. Banks were terrified to lend. People had no savings because so many banks had failed and taken their money with them. So the government stepped in and said, we need to restart this engine.
And how did they do that?
The FHA's core mission from its inception was to advocate for lower down payments, to make home ownership accessible again to regular working people.
So the government basically went to the banks and said, listen, if you accept a lower down payment from a borrower, we, the government, will insure that loan against default.
Exactly. The government took on the risk, and that policy stands today. If you qualify for an FHA loan, you can buy a home with just 3.5% down. It effectively lowers that enormous barrier to entry, allowing people to enter the market years earlier than if they had to save up the full 20%.
But, and there's always a but, if I only pay 3.5%, I'm a much riskier borrower, right? Based on everything we just discussed about the buffer for the bank.
You are, absolutely. And you pay for that privilege. Usually it's in a form of something called mortgage insurance premiums, or MIP. You're paying an extra monthly fee to a third party to insure the bank against the risk of your low down payment.
So you pay less up front, but you pay more every single month over time.
It's expensive to be poor.
That is a recurring theme in finance, unfortunately. Now, speaking of low down payments, there is a specific era mentioned in our outline that we absolutely have to discuss. The anomaly. The years between 2000 and 2007.
The Wild West.
What on earth happened here? Because the notes say lenders started accepting smaller or even no down payments without the government forcing them to.
This was a period of extreme market optimism bordering on mass delusion. The single driver here was rapidly rising home prices.
The old mantra, house prices always go up.
That wasn't a mantra, it was a religion. And if you as a lender believe that house prices will go up 10% or 15% every single year like clockwork, then the down payment becomes mathematically less important to you.
Why is that?
Think back to the buffer. If I lend you 100% of the money for a house today, but that house increases in value by 10% next month, the market has effectively created a 10% equity buffer for me out of thin air. I don't need your cash because the market appreciation is providing my safety margin.
So banks got greedy. They just wanted to issue as many loans as humanly possible to capture that rising tide.
And to do that, they had to remove the friction. They had to remove the biggest hurdle, which was the down payment. The source lists some of the creative financing structures that emerged during this time.
Let's walk through these, because some of them sound completely unbelievable in hindsight.
Well, the simplest one was just straight 100% financing. No money down. You just sign the paper, get the keys. No cash needed to change hands from the buyer.
That just sounds like a trap.
For many, it was.
Yeah.
Then you had these things called seller-assisted down payments. This is where the seller of the house would actually give the buyer the money for the down payment.
Wait, what? How does that work?
Usually by inflating the sales price of the house to cover it. So if a house is really worth $200,000, We all agree to write up the contract for $210,000, and the seller secretly hands me a check for $10,000 at closing, which I then give right back to the bank as my down payment.
It's just a circular flow of money designed to trick the underwriting software.
Precisely. But the most famous one, the one that really defined the era and caused so much damage, was the 80-20 split.
I remember hearing about this, the 80-20 loan. How did that work?
It was a clever and very dangerous way to dodge the 20% down payment requirement while technically fulfilling it on paper. Let's say you want that $500,000 house, but you have $0 saved.
Okay.
The lender would split the financing into two separate loans. First, they'd give you a standard mortgage for 80% of the value, so $400,000. To an investor, this looks like a safe, prime loan with 20% equity.
Right, that covers most of it. But what about the other 100,000?
Then simultaneously, they would issue you a second mortgage, often called a piggyback loan, for the remaining 20%, the 100 grand.
So I am literally borrowing the down payment itself.
You are borrowing the down payment, and usually at a much, much higher interest rate, because that second loan is incredibly risky. But the key is, you walked into that house with zero cash down. You just have 2 monthly mortgage payments instead of 1.
This feels like an absolute house of cards. Because if the market turns even a little bit...
And when the market finally turned in 2008, these were the borrowers who went under first. They had zero equity. They often had 2 loans, one with a variable interest rate that was suddenly skyrocketing, and the house was suddenly worth less than their combined debt.
This is why the foreclosure crisis was so severe.
It's a huge part of it. The skin in the game that we talked about earlier, the psychological anchor. It didn't exist for millions of people. It was easy to walk away.
So the down payment isn't just a rule for the bank, it's a stabilizing force for the entire economy. When you remove it, things get very volatile very fast.
It removes both the psychological and the financial anchor for the whole system.
So that was the anomaly. But are there legitimate ways to get around a down payment today? Or are we back to the strict 20% world for everyone? The outline mentions some exceptions to the rule.
We are definitely not back to a strict 20% world. And yes, there are legitimate safe ways to get zero down financing, but they're typically restricted to very specific groups of people.
Okay, who gets the golden ticket?
First and foremost, veterans. The Department of Veterans Affairs, the VA, offers complete 100% financing for qualifying veterans and service members.
This is a huge benefit of service.
It's massive. The government effectively stands in as the guarantor for the loan. They're saying, this person served the country, so we will be their down payment buffer. It allows veterans to start building wealth through real estate without that enormous initial capital hurdle.
That makes a lot of sense. It's a service dividend. Who else gets this kind of deal?
This one surprises a lot of people. The USDA.
The Department of Agriculture. I thought they dealt with, corn subsidies and farming regulations.
They do, but they also care deeply about rural development. The USDA Home Loan Program offers complete mortgage loans, zero down for qualifying borrowers who are purchasing homes in designated rural areas.
Now, that word rural is doing a lot of heavy lifting there. Are we talking about buying a farm in the middle of nowhere?
Not necessarily. The USDA's definition of rural is surprisingly generous. It can include small towns or even the outer edges of major suburbs. The goal is to encourage population distribution, to stop everyone from cramming into the big city centers and help develop smaller communities.
So if you are willing to commute a little bit further, or if you work remotely, you could potentially bypass the down payment entirely.
Correct. It's a strategic incentive offered by the government.
Okay, so veterans and rural buyers. What if I'm neither of those? What if I'm just a regular person trying to buy a condo in the city and I'm really struggling to save that 3.5% or 5%?
Then you enter the very complex but very helpful world of down payment assistance or DPA programs.
Is this just like charity? A handout?
It can take many forms. Sometimes it's a grant that you never have to pay back. Sometimes it's a low-interest second loan. Sometimes it's a forgivable loan, meaning if you stay in the house for, say, 5 years, the loan disappears.
And where does this money come from?
All over the place. State housing agencies, local housing authorities, nonprofits, or sometimes even the lenders themselves. The source material really emphasizes that these programs are all different. There is no single federal standard.
So you really have to do your homework and see what's available in your specific state or city.
You really do. But the assistance can be significant. It can be up to 3% of the loan amount in some cases.
Which, if you're trying to get an FHA loan that only requires 3.5% down, covers almost the entire thing.
Exactly. It can bridge that final painful gap. And often, these funds can be used for your closing costs, too, not just the down payment. But, and I love this little detail in the research, there is often a non-monetary cost to getting this assistance.
What do you mean by that?
The education requirement.
Education, like I have to go back to school to buy a house.
A very specific kind of school. Many DPA programs require the borrower, the first-time home buyer, to take a short course on homeownership, budgeting, and financial responsibility.
So basically a class on how not to go broke and get foreclosed on.
Essentially. And the source notes that sometimes even the loan officer handling the application has to take a course to make sure they understand all the specific regulations.
You know, I actually find that really encouraging. It goes right back to the idea of the down payment being a test. If you can't provide the capital, the money, you have to provide the labor, the education. You have to demonstrate your commitment in a different way.
That's a beautiful way to frame it. It substitutes cash equity with sweat equity, or maybe brain equity is a better term. It ensures that the borrower really understands the weight and the responsibility of the contract they're about to sign.
Before we start to wrap this up, there's one last group we have to talk about. The people who aren't looking for a primary residence, a home, but an investment. If I want to be a landlord, does all of this still apply? Or is it a completely different game?
It is a completely different game. The source calls it, and I think this is the perfect phrase, a different animal.
Why? A mortgage is a mortgage, isn't it? The numbers are just bigger.
Not to a risk manager at a bank.
Hmm.
Think about the psychology. If you lose your job and money gets tight, what is the very last bill you stop paying?
The roof over my head. My home.
Right. You will stop paying your credit cards, you might sell your car, you'll eat ramen noodles for months, but you will do anything to pay your mortgage because you need shelter.
Right.
But what if you also own a rental property across town that's losing money every month?
Well, that's just a business line item. If it's bleeding cash, I'm going to cut it loose to save my own home.
Exactly. It's a ruthless but rational calculation. Investors are much, much more likely to strategically default and walk away from an investment property than a homeowner is. And that makes investment loans explicitly more risky for lenders.
So how do they punish you for that extra risk?
In a couple of ways. First, they'll almost certainly charge you a higher interest rate. But more importantly for our deep dive today, they demand a significantly higher down payment.
So no 3.45 per 6 FHA loan for my burgeoning rental empire.
Definitely not.
Yeah.
You are looking at a minimum of 20%, more likely 25%, and in some cases, maybe even 30% down. The bank wants a massive buffer because they know your emotional attachment to that property is zero. Your skin in the game has to be purely financial.
That makes perfect sense. The less heart there is in the deal, the more cash needs to be in the deal to make up for it.
That is the perfect summary of the risk relationship in lending.
Okay, we have covered a ton of ground here. From the basic definition of the check itself, to the inner workings of fractional reserve banking, to the wild history of the 2008 crash.
Sure.
Let's try to synthesize this for everyone listening.
Sure.
First, we learned that the down payment is literally the fuel for the lending system. It's the capital that allows the bank to leverage its own money and create the loan in the first place.
And at the same time, it acts as that protective moat, protecting the bank's profits and covering all their messy costs if things go south.
Then for the borrower, for you, it's a signal of discipline. It proves you can save. And it acts as a binding agent, that skin in the game, so you don't just walk away at the first sign of trouble.
And we saw that while 20% is held up as this gold standard, the reality is a whole spectrum. It goes from 0% for vets and some rural buyers to 3.5% for FHA-backed loans, to the insane 80-20 chaos of the mid-2000s, all the way up to the high demands placed on investors.
It's a dial that the market turns up or down based on risk and the economic conditions of the day.
Precisely.
So as we close this out, I want to leave the listeners with a final thought. What is the one thing, the big aha moment from all this research that you want people to really mull over?
I want everyone to really think about the concept of forfeiture and the fundamental asymmetry of this system. We're trained to think that the bank is taking a huge risk on us. But the down payment is designed so that the bank takes almost no risk until you have lost absolutely everything.
Explain that one more time.
If the value of your house drops, you lose your equity first. The bank's position is untouched. If the entire transaction fails and you're foreclosed on, you lose your entire down payment first. The entire structure is built to ensure the lender's profit margin is the last thing to die. It turns what feels like a simple purchase into a calculated risk where you, the individual, are the first line of defense for the bank's balance sheet.
That is slightly terrifying to think about.
It is, But it's also empowering to understand it. When you write that check, you aren't just buying a house. You are underwriting the bank's safety with your own life savings.
You are buying your own credibility in their system. Well, on that sobering note, next time you see a for sale sign, remember, it's not just a house. It's a complex web of risk, signals, and leverage. Thanks for diving deep with us.
My pleasure. See you next time.